Welcome to Stock Art. Today, we are going to learn about the various chart patterns in stock market. Chart patterns are identified with the help of lines that are drawn on chart, either connecting the closing price of the stock or the high and low prices of the stock. They are formed based on past data and so helps to anticipate future direction. They can occur within an uptrend or downtrend or may mark a beginning of new trend. There are mainly three types of pattern. 1. Reversal pattern. 2. Continuation pattern. 3. Bilateral pattern. Reversal pattern is a pattern that causes the general trend to be reversed. Continuation pattern is the one which does not vary the general trend but provides a small time relief to the trend players, for consolidation. Bilateral patterns are those which may result in reversal or continuation of a general trend. Today we are going to look into the reversal patterns. They are 1. Head and shoulder. In this pattern, the stock price comes to a high price in an uptrend and then hits a low price. It again goes up to create a higher high but returns to the previous low. Then, it goes up to the high price made first and the trend gets reversed to a downtrend. Thus, it will look like a person's head and shoulder and hence the name. 2. Double top. Here, the stock price comes from an uptrend and creates a new high. Then, it goes down to create a low price but returns to the previous high. It hits the same high two times, giving it the name, double top. A downtrend would likely start at this point. 3. Double bottom. This pattern is like the inverted double top. Here, the stock price comes from a downtrend and creates a new low. Then, it goes up to create a high price but returns to the previous low. As it hits the same low two times, it is called the double bottom. From here, the uptrend may begin. 4. Rising wedge. It is a reversal pattern when the stock is in an uptrend. Rising wedge is created when the high and low price are ascending each time the stock goes up and down. However, 1 point increase in high price results in a 2-point increase in the low price, slowing the bull strength and bears coming to capture them. As a result, downtrend may start. 5. Falling wedge. It is a reversal pattern when the stock is in a downtrend. Falling wedge occurs when the high and low price are descending each time the stock goes up and down. Here, a 2-point decrease in high price results in 1-point decrease in low price, slowing bear strength and bulls coming to take them. As a result, uptrend may start. 6. Inverted head and shoulder. In this pattern, stock comes down to a low price in a downtrend and then hits a high price. It again goes down to create a lower low but returns to the previous high. Then, it goes down to the low price made first and the trend gets reversed to an uptrend. This is how they all look. To be continued.